There are four different strategies you can use when investing in individual stocks. So you have value investing, growth stock investing, dividend investing, and speculative investing. Let's dive in. So here's the difference between each, and we're going to reference the four M's. If you don't know what the four M's are, go ahead, check out that video. And they essentially go as follows. So you have the margin of safety. That's the math part of investing. That's what Tykr really does for us automatically. Then you have the meaning. That's that second M. That's the business model. How does it make money? Then you have the third M, which is the moat. That's how the business really compares to the competition. And then you have the management. That's a track record of the CEO. Do they have a background of building businesses and increasing share prices? So with the first strategy, that's value stock investing. That's when all four M's check out. The business, it's on sale in Tykr as a high score, high margin of safety. It's green. It's looking really good, but it also has a strong business model, strong competitive advantage, and it has a really strong CEO. So we look as value investors, we're looking for these value stocks. This is the most reliable investing strategy, especially for achieving consistent returns. In my case, I've been using Tykr to buy value stocks. My average returns over the last 8 years or so is closer to about 50% per year. We usually set expectations with people. You want to aim for between 15 and 50%. At the end of the day, you're looking to beat the market. It's a great way to accelerate your wealth building process. So that's the first strategy, value investing. Moving on to growth stock investing. Now, the difference between growth stock investing and value investing really comes down to this. It will pass 3 M's as opposed to 4. And the one M it won't pass is that first M, the margin of safety. And here's an example. So Tesla has been a high performing stock for years. Full disclosure, I don't invest in the stock, but this stock had pretty bad financials for a while, yet the stock kept climbing. And that's really due to it having a strong meaning, moat, and management. Strong business model. It's got higher quality vehicles. Some would argue no, but they really were an early adopter here, getting ahead of the competition. Speaking of competition with a moat, they didn't have a lot of competition for a while. So a really wide moat in that case. And then management, whether you like Elon or not, there's a lot of people out there that get behind him. And having a CEO with a track record of building businesses in the past adds a lot of confidence to not only retail investors like you and I, but also institutions. Elon helped build PayPal with Peter Thiel. That business has done very well through the years, especially in the earlier days. So that's a great example of a growth stock. There's a lot of other business out there that people can get confused and they're like, well, that's a growth stock. But if you go to Tykr and find out if it passes all four M's, it's actually a value stock. In summary, be careful. Growth stocks can be rare because they can sometimes be confused with speculative stocks. We'll get to those in a moment. All right, so moving on to the third strategy, that's dividend stock investing. Now, I kind of put this in its own category. Some people are focused on dividend investing as a sound strategy for building wealth. It's going to take you forever with that strategy. Sure, you could buy some really boring businesses and stick with them and just match the market returns of like 6 to 8% and think you're getting rich by investing in dividends. It's going to take you decades. You're going to find out if you use Tykr, you're going to get much bigger returns with value investing. You won't even care what your dividend payments are with dividend investing. I recommend if you get to a point in your life where you're nearing retirement or financial independence, you have a few options. You can go into bundled products like ETFs, index funds, and mutual funds, and just kind of match market returns and keep your money there. Or you can move all your money towards dividend stocks and then take quarterly payments. That way you don't have to sell stocks to kind of enjoy your hobbies. So that's what dividend investing is really for. It's really for people who are much further along. They have a lot of capital, and now they just want to use this to kind of, enjoy their hobbies, travel, play golf, whatever it is you enjoy, go and do that. But for building wealth, not a sound strategy. Value investing is the way to go. Okay, now let's dive into the last one, speculative investing. This is where most stocks fall, and this is where a lot of YouTube influencers and TikTok influencers, people on Reddit, people on Twitter, they're pumping these stocks. And I love hearing what they have to say. Then I jump over to Tykr, look them up, realize, wow, that's a garbage business. And then you do a 4M checklist, realize that the business model is horrible. It only has one stream of income. There's no competition, and the CEO has no background in building previous businesses. They haven't taken other businesses public. They haven't built solid businesses in the past. In fact, in most cases, you don't even know who the CEO is. That for sure is a speculative business. In other words, speculative businesses fail all 4Ms. So if you're looking at a business that is really climbing high, we recommend get into Tykr, do a 4M checklist to really determine, is this a growth stock or is this speculative? It's speculative. Your chances of losing money are really high. Overall, if you really want to avoid your chances of losing money, we recommend go to value investing. It's safe. It's consistent. This is a lot of what Warren Buffett teaches, Charlie Munger, Phil Town, even the guys on the Motley Fool Money. Value investing is the way to go. That's what we're focused on. Aim for those returns that can be 15 to 50%. Don't try to put all your eggs in one basket and try to hit a grand slam with a growth stock thinking you can go to 1,000% in like a year. That is super rare. It's very risky. So overall, hope this video was helpful. If you like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to learn more about investing, go ahead and check out Tykr.com. We'll see you in the next video. Bye for now.